Our topic for today is valuation of inventory. The first question that should come in this class is, what is inventory? Or you can say the stock of goods. So in other terms, I can call it stock of goods that are bought or manufactured with the intention of resale, and hence these are the current assets of my business. Now, how is inventory valued? Inventory is valued at lower of cost, or NRV, that is my net realizable value. So you go for the lower one, either your inventory cost or your net realizable value. In this lecture ahead, I will tell you how to calculate the cost of inventory and how to calculate the net realizable value, and then you compare both of them, and the lower of both of these two is what at which your inventory is valued at. So let's begin with the cost. For the cost of inventory, you consider the purchase price and you add all those costs that are associated to purchase of that inventory. For example, your transportation charges, your import duties. Let me give you an example. Purchase price is, let's suppose, $400. Freight charges $50. Import duty, make it 70, and packaging, make it $30. So if I total the amount, it becomes 550. Yes, that's how I calculate the cost of my inventory. Any problem so far? Keep copying while I write so that you have proper notes of what we are doing in this chapter. Now, if I talk about the value of NRV, my net realizable value, it's basically the selling price minus all costs associated to sales. In cost, you were adding all the costs associated to purchase to the purchase price, but in NRV, in the net realizable value, you subtract all the costs that are associated to sales from your selling price. This was the example of cost, and now I am giving you an example for NRV. I am giving it here so that we can compare the two values. Let's suppose the same inventory that we bought for 400, we are selling it for 800, and the selling cost, the marketing cost, anything that is related to selling is for $200, which will subtract, and I have $600. Now I have the two values. I'll compare both of them and I'll see which one is the lower, the cost or the net realizable value. Since cost is the lower thing, so this is my value of inventory, which is 550. Any problems so far? We discussed what inventory is. We discussed the two ways in which inventory is calculated. One is at cost and the other one is at net realizable value. For cost, you add up the purchase price and all costs associated to purchase. For example, your import duty, your freight charges, your carriage, your packaging. And for net realizable value, you subtract all the cost associated to sales from your selling price. You have the two figures in front of you. After complete working, then you compare the values and you choose the one which is lower. Please copy this example so that we can proceed with another one. Okay, another example to talk about. You are given purchase price of $900, freight charges $80, packaging $20, import duty $50, which is the total 980, 1050. And the question says that it was assumed that it will be sold for, we've bought it for 900, we'll sell it for 1500. But accidentally what happened is um, it fell. You have dropped your inventory and it's damaged. So now it will be sold at 1180 after the repair cost of $100. So what's the scenario? You purchased an inventory for 900, you paid 80 as your freight charges, 20 for the packaging and 50 on the import duty. But and you had this thing in mind that you will sell it for 1500, but accidentally you dropped your inventory, it's damaged. You paid $100 for its repair, and after the repair has done, you are able to sell it at 1180. So I know my cost. What will be my NRV? My NRV will be selling price is $1180. What are my repair costs? My repair costs are $100. I'll subtract that, I'll get 1080. Right? This is my net realizable value. Now I will compare these two and I'll see which one is lower and I'll choose that. Which one is lower? The cost or the NRV? Yes, exactly, the cost. So this will be my value of inventory. I'm using different color for different examples so that you can have separate examples written down in your notebook, and when you revise you can easily figure out which value should be chosen as your value of inventory out of which example. Any problem so far? Please copy this example down. Till then, I am making another example for you. Okay, so now let's suppose if in a question you are given both, like there are 6 costs and 6 NRVs. How? Cost and NRV A, B, C, D, E, and F. Um, 150, 180, 310, 300, same. 255, 255, 375, 380, 145, 130, 510, and 530. So what students usually do is that they total both of them. Let's do it. 50, 310, 60, 255, 1745, and over here 480 1775. I'm getting this total. So what students usually do, they see the lower of the values, which is 745, and they go for it. This is not the correct way. The correct way is that you will see lower of the two, lower of cost or net realizable value. So for you, A, B, C, D, E, and F, in part A you will go for 150, for part B you will go for 300, C remains the same. For part D you will choose 375, for cost E you will go for 130, and for F you will go for 510. I chose the lower value out of cost and net realizable value, and then I am calculating my value of inventory. Just give it a total. What this is, 0, 11, 18, 17, 20. So my value of inventory is 1720 and not 1745. Please copy this example. Then I have two formats for you, which are for the inventory calculation forward and inventory calculation backwards. While you are copying down the example, I would like to tell you that how is inventory valued and when. So we learned we use the cost and the net realizable value, but the valuation of inventory is done usually at the end of my accounting period, either at the end of 12 months or at the end of 18 months, whatever my accounting period is for, and hence you form a T account that is not officially made, but it is there in your mind to find out the value of your inventory. You have the opening inventory, you have the closing inventory, and then you decide which value of inventory to go for. But for this you have two methods. You go for inventory valuation forward and you go for inventory valuation backwards. Why am I using these terms? Because when you are making your final accounts, the income statement and the statement of financial position, the value of inventory is to be calculated and used after the accounting year ends. Like on the last day of your accounting period, that is the value of your inventory at the year end. So since valuing inventory is a difficult task, therefore what you can do, you know that it might take days and weeks to calculate the value of inventory. But in final accounts, we cannot use any other value of inventory. Like, let's suppose this will be the value, or assume XYZ will be the value. So for what you do is that you calculate your inventory before the accounting year ends in order to reach the inventory valuation at the last day. Like, let's suppose 31st December is your last day. You start calculating it on 1st or 2nd December with the formula or the pattern of inventory valuation forwards. You already assume, not exactly assume, but you know what are the values of sales and purchase expected till 31st. You add and subtract that and you calculate inventory valuation forward. Let's suppose if your accounting year is ending at 31st December, but you plan to calculate your inventory on, let's say, 7th or 8th of Jan of the next year. So now, in order to achieve the inventory figure on the last day of the accounting period, you have to go for inventory valuation backwards. Is this clear? Let me provide you formats of inventory valuation forward and inventory valuation backwards. For these two formats, I am assuming that my financial year is ending on 31st of December. So in terms of calculating it forward, I'll start doing my calculation in the last week, let's say on 25th. If you focus on this format, you don't have to learn it, you can simply understand the concept and you can do it on your own exam. Since we are doing the inventory valuation forward, we will add up our purchases. Why? Because if we do any of the purchase of inventory from 25th to 31st December, that will pile up in our inventory, so we'll add our purchases. And if we are selling any inventory during this time frame, so that inventory will be leaving us, so hence we'll subtract the sales of that inventory at cost. Same will be the opposite treatment for sales return. Like, you add purchases, you add sales return, and you less sales and you less subtract purchase returns in inventory valuation forward. Sorry, not the bracket. If you as an owner has withdrawn anything from the business, like you are expecting to take some inventory home during 25th to 31st of December, you'll also subtract that. If you might think that there is some inventory that is, God forbid, robbed, destroyed or damaged by any scenario, you will also subtract that. this is your final amount for inventory at 31st of December. This was my inventory valuation forward. I'll give you 3 minutes to copy this and then we'll move to inventory valuation backwards. Hurry up. Hurry up. Okay, so let's begin with inventory valuation backwards. I can do it here, I'm assuming. What is the scenario? You have to calculate the value of inventory on 31st, but your year accounting here is over, and now you are calculating it on 10th of Jan. So you'll go in the reverse cycle. You'll subtract your purchases, you will add your purchase return, and that's how it goes. Let me write it for you. Please copy it with me so that you can save your time. And that's how you will find out your value of inventory on 31st of December. Please copy this format so that I can end the class. Hurry up. Okay, so kindly take the screenshot if you aren't done copying, and I'll see you in another class with another topic.